You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, that rockin' tune means it is time once again for the Option Block, everyone's favorite, I know it's my favorite, bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, well as from a little thing we like to call Ye Old Options Insider Radio Network. Quite a few programs available on the old network, including well over 400 archived episodes of the old Option Block. Where can you find all of that options goodness? Well, quite a few places, actually. iTunes, Stitcher, AHA, Mobile, TuneIn, and of course, the mothership, the flagship, theoptionsinsider.com. Click on the Insider Radio Network tab, and you're off to the races. All the shows will pop up, and you're pretty much good to go from there. And of course, if all of that was too much work, just grab our mobile app available for iOS, Android, and of course, the Fire OS, all maybe 6 of you out there who use the Fire OS version. We still have it out there for you, so no shortage of ways for you guys to check out the content and then interact with it. Of course, we love to hear from you guys, your questions, your comments. You guys are really the reasons that we do this program. And joining me on the old program, starting off with the man beaming in from the hinterlands of Maine. I think they finally have started to come out from under their 15 to 20 odd feet of snow up there. Mr. Andrew Giovinazzi, the Rock Lobster himself, beaming in from the pit. Mr. Rock Lobster, how are things up there in Maine? Have you broken the 40-degree mark yet, or are you guys still just under mounds and heaps of snow?
40 degrees? You mean on the upside?
Yes.
No. Not yet. Actually, I was yesterday by the water watching the insane Arctic wind blow. It was probably 10 below zero still with the wind chill. It was like 11 degrees.
Really?
Yeah.
We had that a couple of weeks ago. Then it got up to the 50s and 60s. It was 73 degrees here the other day, so it was quite nice. You need to get that up there in Maine.
Yeah, that's all just pipe dreamville for us. That's just, there's nothing close there.
Well,
nothing close to that.
I guess that's what you moved to Maine for, right? You moved to Maine for the lobsters and, of course, those chilly winter temperatures. Good stuff, sir. And also joining us from the land that never gets below a scenic and balmy 50 degrees, known as that metropolis, that paradise, known as St. Charles, Illinois. You know him, you love him as Uncle Mike Tusaw from RCM Wealth Advisors, a subdivision of the ever-growing RCM Alternatives empire. Uncle Mike, welcome back to the old program, sir.
You know, they always talk about how the archaeologists are searching for the Garden of Eden where Adam and Eve were. We know where it is in St. Charles.
That's true. The Mormons had it wrong all these years. It was actually in St. Charles, Illinois, not out there in Utah or somewhere out west like they were all looking. Good stuff, sir. And joining us last but not least via that magic of technology known as the old telephone. You know him, you love him as the Viceroy. Mr. Alex Jacobson from Options Express by Charles Schwab. Mr. Viceroy, welcome back to the old program, sir.
Hey, Mark, it's good to be here today. Janet Yellen is still my favorite person, and lots to talk about today.
All right, I think with that, let's get right to it and dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
Welcome back, everybody, to the old trading block. If you haven't figured it out by now, this is the portion of the show where we break down what was trading, what was moving in the old markets, what was really catching our attention in today's activity. Bit of a schizophrenic day. A lot of the broad indices taking on the chin a bit. S&P's down about 0.5 percentage point. The Dow, the ever-evolving Dow, down about 2/3 of a percentage point or so. The Q is actually rallying a wee bit today, up fractionally on the day, and the VIX cash ticking up a wee bit too, up fractionally on the day as well, closing at 14.13. Perhaps we'll start there because it was a day of some tumult in the big, broad indices as Uncle Mike, your favorite holding, now becomes official. It is part of the big, bad Dow index. So first off, what do you make of this? Do you feel like you're finally trading and investing in a big boy company now that you're part of the Dow?
Well, I mean, I've felt it, in theory, it was part of the Dow in my mind for many years now. So, I mean, it's no big deal. I think that, the one thing that I always think about when companies do join an index, sometimes people try to buy them because the index funds are going to be buying them. I think a lot of that's priced in. So I would caution people who are trying to do that, but nonetheless, hey, we're a Dow stock now, so I guess we're cool.
Does this change your viewpoint at all going forward? People sometimes think when they get, added to these large indices that it kind of changes the nature of the way these products start to trade. They start to become a little bit less of a growth issue, more of just a kind of general old school mature product company. Of course, people have been saying that about Apple for a while. It hasn't really stopped the growth of the company at all. So does this change things at all, or is this kind of just more academic for you at this point?
Normally, I would say yes, because you can make a case for that with Microsoft. I mean, Microsoft had that period of time for 60,000 years where they just basically were flat and just kind of became like an annuity stock, basically, with a small dividend. But right now for Apple, I think I like the prospects ahead for Apple, but I would still remain cautious at this stage that I do think we're closer to the top than to the bottom when we are getting there.
And Microsoft is always the example everybody bandies about for that. They're that high flyer, fast growing name, and then they joined the big indices. They started paying dividends, and they just got extremely boring. And from an underlier holder perspective, it was really boring. She had pretty much a wasted decade there, like you just alluded to. Somehow, I don't think Apple's going to fall into that same trap. I don't think we'll have a wasted decade with Apple going forward. Who knows? It may slow down a wee bit now, but you never know. I don't think we're going to see Microsoft levels of stagnation. We'll see. Only time will tell, of course, but somehow I think Apple can resist that. Speaking of things that are interesting and or academic, Mr. Rock Lobster, we had a lot of stuff cooking on today's market, and of course some stuff cooking on yesterday too, with the ever popular, ever controversial VIX settlement. It seems like every time this time of month, we always have this bit of a debate. Last month wasn't as controversial. A few months ago, it seems like they really settled it pretty high, and the VIX just took off to the downside immediately afterward. A little bit of controversy swirling around this one today. What was your take on the settlement, and then what else caught your eye in today's activity?
Well, I'm just looking at VIX settlement. I mean, it was down. I mean, there was a weird print, but I had it down like 35 or 416. I don't know. I have it down like 50 cents or 40 cents from the close the day before. That could screw people. It can. So the thing is, when you trade the settlement, VIX is so easy to, let's just call it, I don't want to use the word manipulate, but the price can be changed by having some puts bid or something like that. It just has characteristics that can move it, 30 or 40 cents depending. And I know that SIBO's done a lot of whatever to try to kind of smooth all that stuff out, but that's what it is. So it's like, it's like trading the settlement of the SPX, the PM settlement. You put on a position and you're like, okay, why is all this stuff going out with such a crazy bid on Thursday night? Well, because on Friday morning, it could look a lot different. So, you play the settlement as a market maker. I hated settlement because all it did was add a bunch of risk that you had absolutely no control over. So I've talked to the VIX DPM before. He just sits there and he opens the price. He gets a quote and things settle. There's nothing those guys can do about it. So because it's a derivative of a derivative. And I would just recommend to people, close your VIX positions the day before VIX at the latest. If you want to hold a position through, you're going to get what you get. And having any expectation about where the thing is going to open the next day, it's like, I don't know. It's like driving through glass or a brick wall. And you're like, okay, what's going to happen? Well, I don't know. It probably won't be good, but you might skate through it. So...
It's funny. People, we as market makers obviously didn't have any choice. We had to soldier through those periods. That's what they paid us for. But you as a customer have a very clear and demonstrable choice. You can choose not to endure that. And why should you? Just take it off, Just why deal with this nonsense? If you one of those people out there who thinks it's manipulated or thinks these settlements are shady, then just don't put yourself through it. Just close it out. It's a pretty clear choice. And yet people still don't do it, and then they still get upset, whenever the number comes out. So I don't understand that logic. Do you understand that, Andrew?
I don't understand it at all, because you're betting on just throwing money down on roulette. It's either going to be really good or it's going to be really bad. So,
one thing that I want to add to this would be the reason that I like to get out of not just the VIX, but any option before expiration and not go into settlement with it is because unless I'm looking to take the underlying on a short put and actually because I want it, but the reason that I get out of it is, let's say that I'm in a spread and it's a week before settlement, 5 days before settlement, whatever. If the market goes against me, the next day I'm in control. I can make an adjustment. I can get out of the trade. I can do whatever it is I want to do. As soon as the trading stops and you're not able to trade anymore before settlement, you have absolutely no control over what you're looking to do unless you're using other instruments in some way, shape, or form, whether it's the underlying, whether it's futures, or whatever the case may be. But I like the reason that we all trade options in the first place is because we want to take control of our investments in one way, shape, or form. And when you go into settlement, you do not have control. And so that's why I think it's kind of counterintuitive to go into settlement and pretty much anything unless there's some specific reason for it.
Alex, I'd imagine you had some people calling up, as always happens every month, with some issues perhaps with the settlement. Maybe they were happy with it, maybe they weren't, I don't know. What was the feedback you guys were getting on the desk, if any? Were people up in arms this month?
Yeah, there was some unhappiness, and CNBC did a feeding frenzy on it today. And to Andrew and Mike's point, and I know we've talked about it on the show frequently, we can all kind of look back at these settlements and say they're wacky, they're unusual. Andrew talked about ways that large dealers will try to move things around. I don't know a better way to say that, but clients will come back and say, look, I was going to carry it into settlement because I was going to save commissions. And I did an Iron Condor webinar last night, and I do them at night often for our international customers, but they're not exclusively international customers. And one thing we talked about is, on a weekly basis, how volatile this market has been. On kind of a longer view basis, this market has been very unchanged. And, you could talk to two different investors and you'd think they were talking about two different markets. But leaving anything to go into settlement where you have absolutely no control. If you can trade out of VIX on Tuesday evening and not be in there on Wednesday morning, it's like a bad joke. When settlement goes well for customers, they're geniuses, and when it goes bad for them, they were screwed by the market makers. So to both Mike and Andrew's point, you just don't want to be there. You don't want to be in SPX for settlement. You don't want to, if you're trading something at the money and you've got positions on in an equity, you don't want to be in there Friday at 3 o'clock. Is it going to close a penny out of the money? Is it going to close a penny in the money? It's just a silly game to play. And yeah, you may save some commissions by taking that risk, but the risk reward is awful. And that one time there is some funny mark. The one time that the S&P moves 40 points at the opening, and you give back a whole lot of commissions and a whole lot more money. So, as I said, it was a feeding frenzy on CNBC today about it, but you just don't want to be there.
Good advice, sir, as always. Yeah, we said that many times on the show. Maybe it sounds kind of like it's old hat from us by now. We've been saying it again, but I think all of us come to it from different vantage points in the space, but we've all come to the same conclusion, which should give you guys a little bit of pause. That none of us want to go through that. So if you're a customer out there, the nice thing about being a customer is you can pick and choose your battles and choose wisely around settlement, because you don't need to deal with that headache if you don't want to. And I can't imagine a reason why you'd want to, but c'est la vie. That's up to those of you out there. Meanwhile, moving on to some other interesting stuff. If you guys had a chance to attend our big Unusual Activity Summit we did coming up on a couple of years ago now. It's been a while. Hard to believe. But we cited there a lot of interesting studies about informed options trading and a lot of the data that shows volume options trading going into and coming out of both expected events like earnings announcements, as well as unexpected events like surprise announcements, surprise earnings announcements, surprise CEO departures, whatever the case may be. And there's a lot of interesting data showing that options traders really pick it up and do well around those types of events, and options volume spikes around those times and things like that, even going into unexpected announcements. Some more interesting data coming out of the folks over at, it was a professor, Andrew Fodor. He's at the University of Ohio College of Business, as well as some data from the folks at Options Metric and a few other researchers, I believe, collaborated on this study. And they found some other stuff that's a little bit interesting, also a little bit head-scratching at the same time. These researchers analyzed the raw option to stock trading volume ratio, which indicated that options traders are more active than equity market participants around news events, which is interesting. So people around news events, this is anticipated news events, are more active. So that's kind of interesting. People going to the options instead of the stock, which is certainly music to our ears on a program like this. They said that given that options traders are more active before and immediately after the news events, they investigated whether news releases represent profitable opportunities. They found option trading volume contains information on future stock price changes around news releases, and because earnings announcements are significant expected information events, implied volatility increases prior to earnings announcements and then drops off sharply immediately thereafter. No big surprise there. Anyone who's listened to this show for a minute knows that's pretty much what we've said a million times. So that shouldn't surprise anyone who's ever traded an option around earnings. The second part gets a little bit more interesting. They said they found this pattern reduces the profitability of trading strategies involving long options positions and increases the profitability of strategies using short positions relative to when unexpected news events occur. They cited specifically a few events. They found that if volatility remains constant around an event, then an informed investor with a positive signal is better off buying a call than selling a put because of the greater leverage, which is kind of a bit of a head scratcher because they just come out and said that people would do better selling options than buying them, but then they recommend to buy a call as opposed to selling a put, which is kind of interesting. And they found that if the event is anticipated and implied volatility drops and the news is made public, then surprise, surprise, the opposite will be true. Trading strategies that involve short option positions will perform better because the premium is collapsing. Like we said many times on this show, the premium balloon. So a little bit interesting. Some stuff kind of reinforcing things we've already said on the show. Some of it a bit of a head scratcher. I think when they made that blanket statement that it's not profitable to be long option premium going into unexpected type of events like that, I think they really they mean that very specific scenario where the implied vol increases and then implodes dramatically right after the event. And in those types of situations, I don't think it takes a genius to really realize that you're not probably going to do well if you're long a lot of vol. Mr. Andrew or Alex or Mike, anything surprising you in this research, or is this kind of more of what you expected?
This is, God, I'm going to be critical of this research, and I'll tell you why I'm going to be critical of it. Because the challenge to most of this research, when I was at SIBO, there was a professor down at the University of Illinois, Professor Potichman, and he used to come in, and he's written many of the quoted studies, and he used to come into SIBO, still does, and say, could you guys give me the data? I'm going to do this study. And SIBO was reluctant to give away data, but we would ask him what he was trying to prove in the study, and in every case, I mean this literally, in every case, the research always proved what he was trying to prove. My core concern when universities do studies is they look at aggregate raw data, which is viable, but it's like saying, I'm going to look at earnings, but I'm going to look at 1,000 companies' earnings, and then you wash out what the Netflixes, the Google surprise. You know, everybody has an earnings study, but I'm yet to see the data. Every earnings study says sell premium going into earnings, and then everybody tells you there's one or two anomalies every year that reverse the entire study. So, I'm not thrilled with academic studies, but let me put a caveat up there. This is going to sound really prejudiced on my part. The academic studies done at the really good schools, the Kellogg's, the Stanfords, Bob McDonald, the finance professor out at Kellogg, their academic studies are much more methodical and rarely come to these kind of silver bullet solutions. And I place a lot more weight on people who aren't looking to prove something, people who are genuinely doing a study.
Yeah, that's kind of a case, whenever you have some of these big studies, the people have sometimes axes to grind, and sometimes you're right. I think some of the academics out there don't really understand all the different issues that they're looking at. This is something we've actually discussed quite a few times on the Volatility Views program, the surprising dearth of really good studies on this topic, particularly as it pertains to earnings. You see a lot of people quoting earnings straddles and talking about volatility around earnings time, yet for whatever reason there hasn't, except for the exception of one or two Goldman studies a few years ago, there hasn't really been a lot of research done in this particular topic, showing whether one way or the other really outperforms, going short premium, going long premium, or even something as simple as how many names outperformed their straddle in the Fortune 500 or the Fortune 100, the S&P 500, whatever delineation you want to use. Yet for some reason, there's very little research out there about that, which is kind of interesting, which is why this study is kind of caught my eye, because it's not just the typical unusual activity stuff, and certainly we like unusual activity here. We do a lot of it on the show, but it kind of relates to the earnings trades a little bit as well. Mr. Andrew, anything surprised you about this one?
Not too much. To me, a study is a study. I don't. I wish I could pay more attention to them, but it's weird. I have kind of a bias against these studies because I think the people doing the studies should just go trade for like 5 years and see if they would make the same study over again. I don't know. I don't have a lot to add to this one, unfortunately.
Yeah, they kind of do step in a little bit with the study because they make this kind of grand pronouncement that you should be short premium versus long premium. And then in the very next paragraph, they say, well, you do better off buying a call versus shorting a put in these different scenarios. So a little bit of a head scratcher there, you're right. But still interesting stuff. If you're curious about this, we have a link to it on the Options Insider. Listeners, look in our news feed. You'll see the link there. Maybe we'll have a write-up article on it as well. Interesting stuff. We like more data on this space, even the ones that are a little bit interesting. And maybe we'll dig a little bit deeper into this one and talk to some of the study's authors and see what they thought about this data. In the meantime, since we're talking unusual activity, it's time for us to do it. It's time for us to keep on rolling right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, welcome to the Odd Block. This is indeed the portion of the program where we break down the weird, the wild, the wondrous paper that is lighting up the old options market today. And we're going to kick things off with a name that really I'm trying to think, we haven't talked about this one, at least not in quite some time. This is good old Sina Corp, ticker symbol SINA. Closing today about 32 in the orders or so, down a little over 1% on the day. And this is the name that does about 6,000 contracts a day, doing nearly 2x that, about a little bit shy of 12,000 on the day. And what caught our eye, we talk a lot about upside call buys pretty much in this segment. That's the lion's share of the paper that we see. This one a little bit different, going to be a little bit longer term and on the dark side. This was coming on the put side of the fence. All right, and what caught our eye out here in Sina Corp today, like I said, was a little bit on the longer term side. On the put side of the fence in particular, it was the Jan 20 puts that caught our eye, going up for 1,672 times to be precise. Paper buying, I don't have the exact prices here when they went up. Some of them might have gone up in the $1.20 or so range, but that was earlier. I'm sure the latter kind went up at higher prices. That's on some sizable open interest of about 1,377, nearly 14,000 contracts. So someone is got some size open on this Jan 20 strike out here in Sina. Looks like they're buying some of them back. So if I had to guess, someone was blasting out some puts out here and deciding for whatever reason, perhaps to take some of those off. These are always a bit of a head scratcher when people start unwinding positions that have so long to expiration. Yet perhaps there's some method to his madness. And of course, these puts still being, the stock's off 1% today, but there's still 12, 13 handles out of the money. So it's not like these are in danger of becoming relevant anytime soon. Yet still a bit of an interesting play here. Looking at the chart here, the 20 handle is certainly fairly aggressive. This thing was trading $90 not that long ago, back towards the end of last year, even the beginning of this year. So the 20 handle would indeed be quite the scoop out here. So I'm not sure if this guy is indeed buying back a bunch of shorts, why he would be in such a hurry to do so. Mr. Rock Lobster, what's your take here on our friend perhaps re-scooping some of these Jan 20 puts that he may have blasted out earlier?
I'm still trying to figure out what he's doing. I mean, the one thing I would say is the stock's at the low and the implied vol's at the low pretty much for that length of time. So I guess, I don't know if he's made enough money from the vol coming in or what, or he's just decided that, well, maybe I'm not so interested in selling these 20 puts anymore. They're not a layup. So just, it just kind of bizarre, out of the money put behavior. And I don't quite see why you'd want to buy them back now, because, unless you think Sina's going, back to, 30, 30, I don't know, $24, $22, down another 50%. So I don't see when they could have sold these puts where they would be trading for, a higher price than they are right now with the stock at the bottom of the range. So maybe they're just giving up slowly and early.
Giving up slowly. Yeah, I can't see someone saying, oh, perish the thought, I need to buy this stock at 20 at an all-time terrible low. Why would I ever want to buy these? This is a bit of a head scratcher. We also saw, looks like some little bit narrow term paper actually here. The Jan 20, these are the Jan 2016, 37.5, looks like 37.5, 35 put, maybe 1x3 went up 2,000 by 6,000 times on some pretty sizable open interest, 7,500 by 10,000 contracts. Looks like somebody perhaps unwinding something in the Jan 2016 realm, as well as these, I didn't mention earlier, the Jan 2017 20 puts. So a lot of long-term paper perhaps being unwound here for perhaps dubious reasons. 37.5s, I could see these puts are becoming, or they certainly are right now, they're $5 in the money, so those are relevant. I can see maybe wanting to unwind those strikes, but the 20 strike, a bit of a head scratcher. All right, and that's going to do it for the old odd block for today. A bit of a truncated one as we keep on rolling right on into the Xpress Block.
The Xpress Block, brought to you by Options Express by Charles Schwab. Options Express by Charles Schwab lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources. Options Express by Charles Schwab is the online broker for all traders. Best of all, Options Express by Charles Schwab lets you trade stocks, options, and futures all in a single account on powerful yet easy-use trading platforms, including mobile devices. Visit optionsexpress.com for your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, listeners, you guys know the drill by now. This is indeed the portion of the program where we take a deep dive into the OX by Charles Schwab, talk about the platform, talk about the tools, talk about what the clients are up to, as well as perhaps some cool, interesting things coming down the pike. And our tour guide, as always, is the Viceroy himself. Mr. Viceroy, where are we headed on our tour today?
So we're going to talk covered writing today, and I know on the show we really don't spend a ton of time on covered writing. It's one of the strategies we discuss, but I had an interesting email, and I kind of want to expand on it. An email was from a not sure if they were an OX or a Schwab customer, or candidly, because I didn't look the name up, not sure if they were a customer of either one of the firms, but for the moment I hope they are. And the commentary was, I trade options in my IRA. I'm limited as to what I can do to basically just covered call writing. And let me also point out, that's not an IRA rule. That's brokerage houses can approve strategies other than covered call writing in IRAs. And if you're here at OX or you're a Schwab customer, talk to us and let us know a little bit about your history, and we'll see if we can get you approved for more strategies. But the email questioned, you guys put up a lot of interesting strategies. I don't really have a lot of money. What kind of covered writes can I see in tools like Hub or in any of the other search tools? And I thought it was a particularly interesting question because, I touch on Hub periodically on the show, and I thought I would showcase some of the ideas that are up in the covered writing portion of Hub today. And let me just for a moment talk about what Hub does in covered writing. Hub searches for stocks that trade at least 1 million shares a day, which means we're looking for stuff with decent liquidity. And then it searches for at the money implied, looking at the put-call pair of between 10% and 60%. And candidly, in this environment, 10% is probably a little low. But if you just thought of the arithmetic average and said 10 and 60, that's 70. So it should look for stuff around maybe a 35 vol. Now, again, that's a back of the napkin calculation. It also does one other thing. It looks for a 7% simple static rate of return. What I mean by simple is no annualizing, just 7% for the period from today to the date of expiration. And I'm looking at Hub, and I'm just going to read some of the names. I'm not going to give trade recommendations on the show, but to someone with a small portfolio, the first recommendation on Hub today is Tesla, $181 stock. I know that's not for everybody. Second covered right recommendation is Neighbors Industries. That's a $12 stock. The third recommendation is YY Inc. The fifth is United Airlines. That's about $65 to get in and sell the call. First Solar's on there, but it isn't just $100 stocks. It isn't just 100 volatilities. Twitter's up there today. Pandora's up there today. That's a $15 stock with about a 6 3/4 static rate of return. So it isn't all arcane strategies. It isn't all iron condors or butterflies. There are some fairly vanilla covered rights up there, and there are names you would be familiar with. Twitter, UAL, pretty much household names. If you're looking for a $10 stock because that's your capital, or you're looking for a $20 stock, they're all up there. If you're a OX customer or Schwab customer, the covered writing portion of the hub is available on all OX platforms. Right now it's available on Schwab Mobile. This is where I have to say Options Express and Schwab are separate but affiliated companies. But if you are a covered writer, there's something up there for everyone.
Well said, sir. I'm sure a lot of our listeners do fall into that premium harvesting / covered right section, and I'm sure a lot of them will be interested in seeing what you guys have to offer. And probably something we don't bring up enough here on the show is, hey, there are a lot of alternatives out there for you. You don't need to trade. And we talk about the Apples and the other ones, and Apple's certainly cheaper than it has been, but we talk about a lot of expensive names on this show, and we probably, of course, except for the cheapy biotechs that we do on the odd block, but that's a separate category altogether. But we probably should maybe devote some more time to some more cost-effective type things that people can do out there. If they do have, let's say, under $25,000 in their trading account, which is a lot of people out there, and what they can do with that. Excellent stuff there, Mr. Viceroy. And now it's time for us to keep on rolling right on into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, it's Thursday. That means it's time for us to break open the old mail block, see what you guys have to say, what your questions and comments are. No shortage of ways for you guys to share those with us here on the old program. Of course, you can find us via email, questions@theoptionsinsider.com. Surf on over to the mothership, theoptionsinsider.com, and leave us a comment on a show note. Or, of course, use the old website feedback form. A lot of you guys like to do that as well. Or find us via social media, twitter.com/options, facebook.com/theoptionsinsider. And at Stock Twits, we are Options Insider. So, again, no shortage of ways for you guys to send your comments and questions to us. We got quite a few here. Let's see how many we can bang out here today. Let's start off with a couple of them here. First off, we have some questions and comments from our frequent commenter here, questioner Mark Brant. He wrote last week when I was on, of course, assignment down in the hinterlands of Florida. A very difficult assignment to have this time of year, but c'est la vie, someone had to do it, covering the FIA Association conference. And he wrote, thanks to the crew for a great show and for answering my question. When the cat was away, the mice did play. So apparently people appreciated the shows you guys did when I was gone. So that's good. Makes me know I'm not needed around here. I can go do other things. And he also has a question. This one's for you, Alex. He writes, do block trades show up on the retail brokerage position ledgers as volume and open interest? And I'm not sure why they wouldn't, but perhaps you can think of some esoteric scenarios where they would not, Mr. Viceroy.
So I don't know what a retail brokerage position ledger is. The positions at this firm are all customer positions. There is no house account or anything of that nature. But will a block trade print? Yes, it will. Will it show up as open interest? Yes, it will. But the next day, open interest has a one-day lag. Now, one point about block trades, sometimes very large blocks involve facilitation on the part of a brokerage house, not in the retail community, but in the institutional community. Or if one were going to be done in the retail community, it would probably be done as a facilitation with whoever their smart router points to. So actually a call would get made to a Citadel or a UBS or a Susquehanna because there wasn't enough visible liquidity. But yes, that trade would print. There are no internal positions in a retail brokerage house. At least there aren't any here at Options Express. And they would show up on the tape. By the way, they might show up late. So if you're doing some kind of technical work that looks at volume, be aware of the fact that they could print out of sequence and often do print late. But yes, they would all go up on the tape, and they would be in tomorrow's open interest.
Thank you for that, Mr. Viceroy. I'm being informed behind the scenes here that you guys actually, while I was gone, did answer that question last week. So he gets a double question answer. There you go, Mark. That's an extra whammy for you. Meanwhile, we got to keep on rolling for some more questions. Get people on the show who haven't been answered twice. Speaking of two questions, this next one they have a similar theme, so I'm going to put them both together. This first one comes from Nico. He writes, do I need to understand the Black-Scholes formula to trade options? And the second question comes from James Mile. He writes, I'm currently reading the options books by McMillan and Natenberg. He puts in parentheses, thanks for the great suggestions. Well, you're welcome, James. He goes on to write, the latter chapters of some of these books get pretty deep into the mathematical underpinnings of the options market. I have to wonder if most of the people who are trading these products really understand this stuff. Do you share my concerns that there are potentially millions of people out there slinging calls and puts that really don't understand how any of this stuff works? Great program. Glad OX/Schwab is a supporter of such fine content. Well, thank you for that, James, and also thank you, Nico. Two similar questions regarding options math. The latter books, I'm trying to remember if we've recommended McMillan on the show before. I know I recommended Natenberg a number of times. It's kind of my go-to suggestion whenever people say, what book should I read? I always start them off with Natenberg, so that's always been mine. But a lot of people like McMillan too, so those are certainly two good choices. You can't go wrong with those. And you're right, they do get a little bit wonky, for lack of a better word, in some of the latter chapters. And they do get into some of the derivations of Black-Scholes. So maybe we'll go in order with Nico's first. We touched on this a little bit, I think, recently on the show, so I won't go too deep into this. But we kind of have said before on this show that with Black-Scholes, it's important to know it, but it's really important now. You're not going to sit down and use Black-Scholes to really price an option. It's more to understand the underpinnings of how the market works these days. Things we talk about on this show on a regular basis, like the Greeks, Delta, Gamma, Theta, Vega. All of that is derived from Black-Scholes. And the things we talk about, like volatility components of an options price and things like that, all of that comes from Black-Scholes. So if you don't understand these concepts like the Greeks and implied volatility and all these other cool things, time decay that we're talking about, Delta on this show all the time, all of that comes from Black-Scholes. So it's really kind of hard to do anything else if you haven't really mastered the basic concepts. And Black-Scholes is certainly a basic concept. Most of the major options pricing models have moved well beyond Black-Scholes. Now there's myriad other permutations of ways people use to price options and derivatives these days. So Black-Scholes isn't cutting edge from that understanding anymore. But to understand how options work, that certainly it is an important building block. And the latter part, the second question here, do we worry about people who don't understand the math of what they're getting to? We touched on this kind of recently too. It's one of the reasons why we have this show, not so much for the math, but for the educational elements behind it. But I think Alex just outlined an interesting use case too, people coming to the hub to do covered writes and things like that. A lot of people out there, like the people you mentioned, are doing some of the simple, plain vanilla stuff like that. If they're just coming to it and they're just doing a simple covered write on an equity position that they're going to hold in their account anyway, and they're just doing some very basic 10% out of the money covered call, I don't think they need to know all of the empirical models for pricing and all of the math that goes into it. If they're doing some more exotic stuff, certainly, and we certainly love people to arm themselves with all the information they possibly can. But I don't do too much hand wringing about whether the masses are completely ignorant. Of course, talking about things like we were today about VIX settlement, I think a lot of people are ignorant of concepts like that. So it depends, I suppose, where you're looking. Let's see, we're going low on time. I'll make sure everyone else gets a chance to chime in here. So maybe, Uncle Mike, we'll start with you. What do you have to say for our friends here, Nico and Mr. Mile?
Nico and Mr. Mile. Nico, in terms of the Black-Scholes formula, I agree with Mark in that you need to really have an understanding of the concept more so than anything. In a lot of platforms, sometimes you can get pricing done by the various pricing models of an option, just saying what the theoretical value of an option is based on Black-Scholes, based on Cox-Rubinstein or things like that. But I think the concepts of them is definitely more important. An example that I like to use in school these days, I'm not sure how true it is. Thankfully, in my son's school, it's not. But I hear about how they're not teaching kids how to carry numbers and borrow when you're doing multi-numeral addition and subtraction, and they're just showing them, well, just use a calculator. Calculators are a good thing, but you need to understand the concept as to why 36 plus 48 equals whatever it equals before you really get into the calculator. So I think understanding the concept is what is most important, even beyond the Black-Scholes formula, quite honestly. In terms of what you need to know as to what gets really deep and that type of thing, I think it's good to have a basic knowledge of it, just because I remember one time, it was actually when I was working at Options Express, we were at a trade show and a lady sold a put and the stock went down. And so she was wondering, well, on this short put that I have, how come this one's profitable when the stock went against me? I don't quite understand this. And she was just trying to sell a put to get into a stock. It was a very basic trade, as Mark had discussed. But we had looked at that, and so we looked at the stock, looked at what was going on with it. Well, it turned out that the stock did go down slightly, very minimal, but the stock had an earnings announcement, and the earnings announcement, as a wise man I know very well would say at the time, was a resounding meh, meaning it didn't really move it that much, although it did move slightly downward. And so what happened is the implied volatility was taken out of that option because of the non-event that the earnings announcement was. And because of that, Vega beat Delta on that trade. And so what I think is important for that, James, is if you are doing something basic, it's good to have a basic understanding of it. And but I agree with Mark in that the more advanced you get, the more knowledge you need to have in terms of the exoticness of the strategies with which you're doing. But even if you're doing something basic like a short put sale to get into a stock to then write some calls against it, still doesn't hurt to have a little bit of extra knowledge as well.
Mr. Andrew, you spend your days dispensing knowledge. Anything to add here for our friends, Mr. Nico and Mr. Mile?
And dispensing them. At least the way I think about it, if you want to trade options, if you want to invest with options, if you want to do anything with options, you should educate yourself, because a lot of the simple things you can learn, a lot of the simple things about options you can learn. Options are teachable. Floor trading was teachable. Understanding how options are going to work is a teachable thing. But it's like anything else. It's like learning how, I'm not going to say it's like learning how to be a doctor or lawyer or something like that. You need more training, but you should avail yourself and learn how options work. And the thing, at Option Pit, we're basically saying, we don't know how every option is or how every underlying is going to move, what's going to go up or down any particular day. But if I understand a set of circumstances, I know what the best trade will be. So you can figure out, based on the conditions of the market, what trades have a good chance of success and which ones don't. And it's all a probability thing, because options basically are priced from volatility, and volatility is just a statistical number based on variance. So the idea is some option trades from the outset have almost no chance of success. You can learn what those are by education. You could learn other ones, option trades that have a very good chance of success. You can learn that by education. Is everything going to work out exactly? There's always a little bit of room and probability for things to work out not how you want, but you can structure a lot of that away. And by understanding how the Black-Scholes model works, it has quirks. And the quirks of the model go into the pricing of the options. And once you understand how the model works and what those quirks are, right, because it has a lot of assumptions, then you have a better shot at, putting on option trades and just, buy writing options when you have a better shot of success versus there's a good time and a bad time. So if you understand how the model works, obviously at Option Pit, we do a lot of education in that realm, starting with the model and building up on the Greeks and building up on market conditions. And that way you have, I think at least when you see something happening, you can understand why things are priced that way. So what I would say is most people that trade options, they try to find a way to educate themselves one way or another. You could educate yourself by buying some education from somebody. It could be us. It could be anybody. It could be going to the OX website. They got a lot of good stuff there, right? Or you're going to learn the hard way, which means you're going to lose money and you're not going to do that again, because there's going to be something there that will obviously ring your bell. So all I can say is, if you don't want to educate yourself, you go trade and take your money at your own risk.
Mr. Viceroy, take us home. What do you have to say here for our friends asking about options math and the Black-Scholes formula?
We've talked about this a lot, and my view on this has changed a bit, but I will re-quote Fisher Black. I was on a panel with him many years ago, and he said the Black-Scholes model is not for pricing options. He said the marketplace is for pricing options. The Black-Scholes model is for setting expectations. And Andrew, in his last couple comments, really talked about that. And I think you'll find that Mike, myself, Andrew, people like us who've been in the business a long time, most of what we do is not based on decision-making of Black-Scholes. It's based on intuitive stuff. I mean, Apple on January 27th, the weeklies were trading 100 vol. The regular expiration was trading 40 vol. If you bought a weekly call $5 or $6 out of the money, the stock went up and you didn't make money. Anything that will help you understand implied volatility, whether it's a book, a piece of software, or a piece of education, and what a really well-educated trader will be good at, they will not be good at making money, but they will be terrific at not losing money, not putting up a bonehead trade. Andrew used the term a trade that, can't make you money. And that's real important. But I think if you dig down in Andrew, who was a market maker, I'll bet he'll tell you most of the time he spent on the floor, his decision making was intuitive, or he was pricing off a simple concept like parity, or he was pricing in response to the stock price and rarely was actually rerunning prices and looking at vol and the ability to learn from someone terrific. And I've talked about this before. Is education good? Of course education is good. Is paid education good? Is free education good? Some paid education is terrific. Some paid educators are charlatans. I mean, just horrible folks with get-rich-quick schemes. But is education beneficial? Yes. Genuine education is beneficial. Understanding options will not help you get rich, but it will help you from doing that bonehead, buying the Apple 120 call, paying 130 vol with skew, and even if the stock had gone up on that day $15, you wouldn't have made money.
All right, good stuff. We have to leave it there. And unfortunately, that's all the time we have for this episode of the Option Block. We went a little long answering your questions, but there are certainly worse things to be doing on the show here than giving you guys some time in the old sun. We love to hear your questions and those comments. Keep them coming. Meanwhile, before we go, really quickly, let me check in with each of my cohorts here on the old All-Star panel, see what they have cooking that may interest you until the next time we all can gather here together. Starting with you, Uncle Mike, what's coming down the pike in the land of RCM Wealth Advisors?
Yeah, I'm just watching. Want to see if we can make some new all-time highs tomorrow. We got about 25, 30 points to go, something along those lines in the S&P. We got a shot at it. And then in terms of what's coming up at RCM, it is tax time, folks. So if you have not done your taxes yet and you need advice on whether to do a Roth IRA or a traditional IRA and you'd like to contribute to some type of retirement plan and you need help, guidance, please give us a call. We'd be more than happy to discuss those things with you. 312-212-3531.
Well said. Same thing for you, Mr. Rock Lobster. Anything really quick you're watching for the rest of this week, as well as what's coming down the pike in the land of the pit?
Actually, there's almost nothing left for this week, which maybe that will have a big surprise tomorrow. I don't know. And as far as option bit goes, we will have our next Saturday webinar. I believe we will have it for you on Tuesday or Thursday. We'll let you know when that is. The last one was very well attended, and we'll also be promoting basically a package of webinars too. So again, if you want that education, the cost of our webinars relative to what it might cost you to do what Alex just said, the stupid stuff, I think it's a pretty fair deal. So again, we'll be getting back to you guys with that shortly.
All right, and last but certainly not least, Mr. Viceroy, any quick things you're watching for the rest of this week, as well as what's coming down the pike in the land of OX education and live events?
Quickly watching the 10-year down to a 197 yield. I think it's going lower. in the short run. Handful of events. Next live event, Saturday, March 28th, Dallas, Texas. Jimmy Ruzan and the crew. A couple webinars this Tuesday, March 24th. Nina's going to do a trading platform and a tour of the site, basically onboarding for new customers. After the close, I'm going to do the Idea Hub. Wednesday the 25th, Mike Zaremski is going to do new customer onboarding for new futures traders so they can understand the platform, how to bring up futures options chains, and then in the afternoon, Nina's going to do collars in IRA accounts. All the events are free. Come to optionsexpress.com and just click on the free education tab.
All right, thank you for that. And on behalf of the Viceroy and the Rock Lobster and Uncle Mike and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. Keep them coming, and we'll see you next time right here on the Option Block.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.